Taxes are typically one of the largest expenses of your life. You can't avoid them, but you can pay less. I'm Jessica Lanning. I'm a certified financial planner and former attorney. I help families and entrepreneurs turn wealth into clarity and confidence. Today, we will talk about ways to reduce your tax bill legally and confidently. Now, mind you, this video is for education. It's not personal tax advice. Every situation is different, including yours. So be sure to work with your tax professional on what applies to you. The first thing I want you to do is to understand how marginal tax brackets work. A common misconception is that when you earn more, your entire salary is going to be taxed at a higher rate. That's simply not true. We have what's called a progressive tax system. Only the next dollar that you earn moves into that higher tax bracket. And understanding this really matters because it can keep you from turning down raises or consulting work because you think you're going to lose all this money to taxes. The next thing I want you to pay attention to is maximizing your retirement contributions. Whether it's a 401k, a SEP IRA, 403b, 457, solo 401k, I want you to make contributions that are going to reduce your taxable income today and grow it for tomorrow, particularly if those contributions are matched by your employer. One of my clients contributed $25,000 to one of her accounts, and that saved her over $8,000 in federal taxes that year. And if you are self-employed, you have the ability to put away $200,000 or more every year tax deferred. Pay attention to these strategies. If you are a self-employed person, I also want to make sure that you're using the right structure. Employees earn, they pay taxes, and then they spend. Whereas businesses earn, they pay legitimate expenses, and then they get taxed on what's left. And that difference can be tens of thousands of dollars, especially for consultants, professionals, or small business owners. And as a self-employed person, you need to be looking for opportunities to take expenses as reductions on your income. I also want you to pay attention to building income streams that the government taxes differently. Roth IRAs are one of my favorite. If you contribute after-tax dollars to these accounts, your growth in those accounts are tax deferred, and the withdrawals in retirement after 59 and a half are tax-free. I've seen women in their 40s contribute during lower income years, and now they're set up for decades of tax-free growth and tax-free access. One of my favorite topics is how to manage capital gains taxes well. Whether you've bought a house or a business or stock or cryptocurrency, you bought it for $2, it's now worth $2 million. I'm only sort of exaggerating to make my point. There are lots of ways to manage the capital gains taxes that are going to happen as a result of owning this kind of an asset. Now I'm going to go through these relatively quickly because, again, this is all particular to your situation, but it's what I want you to be talking to your tax professional about. The first one is perhaps doing an installment sale. Like, for instance, if you have a business, can you do an installment sale? Or can you do something called an intermediated installment sale? Those are both worth looking at because it allows you to manage the taxes over time so that you ultimately end up paying less. Along those lines, there are timing strategies. When you are in a low income year, our capital gains tax system is also progressive. In lower income years, you might actually be able to realize capital gains and not pay any taxes on them at all. There's also gifting strategies. You can gift highly appreciated assets to family members strategically or to charity and be able to save yourself the capital gains taxes that would otherwise be due. Don't forget, always, you have a 121 exclusion on your primary residence, which allows you to shelter $250,000 or up to $500,000 in gain on those properties when you sell them. And with property, you always want to look at 1031 exchanges with investment properties. And if you own, let's say, an annuity or a life insurance policy, you might want to look into a 1035 exchange. Again, an opportunity for you to avoid having to pay capital gains taxes in one fell swoop when this particular sale and purchase happens. There's also something called a qualified small business stock exemption that you should be looking into if you own a small company that might allow you to shelter enormous amounts of capital gains taxes on the sale of your business. And opportunity zones are coming back into vogue thanks to the One Big Beautiful Bill Act. And those should also be in your quiver of opportunities to be able to delay and perhaps not have to pay quite so much in capital gains taxes. At Lanning Financial, my framework is simple. Clarity, choice, calm. Clarity, seeing where your income really goes, managing your expenses. Choice, modeling contributions, using different structures, Roth accounts, and calm, knowing that your money is working for you. Download my free Tax Smart Planning Checklist in the description. And if you'd like to see if we're a good fit, click on the contact page at lanningfinancial.com. My team will reach out within 24 hours to schedule a call. Please subscribe for more videos, and in the comments, tell me which tax strategy got your attention, or one that you've used, or one that you've avoided. I'm Jessica Lanning, and I'll see you in the next video.